Overview of finance function. We all know that financial analysis plays important roles for success of an organization. It helps the manager to move an organization in the right direction to fulfill the financial goals. In this lesson, we will discuss finance functions, describe the finance manager's role, and discuss the financial goals. After going through this presentation, you should be able to define financial analysis, explain finance function, describe the finance manager's role, analyze the financial goal. Financial analysis is the process of identifying the financial strengths and weaknesses of the firm by properly establishing relationships between the items of the balance sheet and the profit and loss account. Financial analysis refers to the assessment of a business to deal with the planning, budgeting, monitoring, forecasting, and improving of all financial details within an organization. In short, it refers to an assessment of the viability, stability, and profitability of a business, sub-business, or project. It is performed by professionals who prepare reports using ratios that make use of information taken from financial statements and other reports. A finance function includes investment decisions, financing decisions, dividend decisions, and liquidity decisions. A firm's investment decisions involve capital expenditures. They are referred as capital budgeting decisions. A capital budgeting decision involves the decision of allocation of capital or commitment of funds to long-term assets that would yield benefits in the near future. There are two important aspects of investment decisions. First is evaluation of the prospective profitability of new investments, and the second is the measurement of a cut-off rate against that of the prospective return of new investments could be compared. Financing decision is the second important function to be performed by the financial manager. Broadly, he or she must decide where from and how to acquire funds to meet the firm's investment requirement. The mix of equity and debt is known as capital structure. Dividend decision is the third major financial decision. The proportion of profits distributed as dividends is called the dividend payout ratio, and the retained portion of the profits is called retention ratio. Investments in current assets affect the firm's profitability and liquidity. A financial manager is a person who is responsible to carry out the finance functions in a significant way. Roles of finance managers are fundraising. It is one of the important functions of a finance manager. The finance manager can raise the needed funds during the major events such as promotion, expansion, or diversification in the firm. Next is funds allocation. Managers are responsible to assess and examine the economic viability or profitability of the proposed allocations. Next is profit planning. It is a prerequisite for optimizing investment and financing decisions and also helps to anticipate the relationships between volume, costs, and profits. The last is understanding capital markets. Managers should also know how risk is measured and how to cope with it in investment and financing decisions. Profit maximization and wealth maximization of shareholders are the financial goal. Shareholders' wealth maximizing is the net present value of a course of action to shareholders. Net present value NPV or wealth of a course of action is the difference between the present values of its cost. Maximizing the shareholders' economic welfare is equivalent to maximizing the utility of their consumption over time. The market price serves as the firm's performance indicator. If you have understood the various concepts discussed in this lesson clearly, the proportion of profits distributed as dividends is called the dividend payout ratio, and the retained portion of the profits is called financial mix. Right or wrong? Wrong. Profit maximization does not ignore the timing of returns and risk. Right or wrong? Wrong. The objective of shareholder wealth maximization is an appropriate and operationally feasible criteria to choose among the alternative financial actions. Right or wrong? Right. Before we end, let us briefly revise what we have studied so far. Financial analysis refers to an assessment of the viability, stability, and profitability of a business, sub-business, or project. Finance functions are investment decisions, financing decisions, dividend decisions, and liquidity decisions. A capital budgeting decision involves the decision of allocation of capital or commitment of funds to long-term assets that would yield benefits or cash flows in the future. Profit maximization and shareholders' wealth maximization are two financial goals. NPV is difference between present values of cash in and outflows. The proportion of profits distributed as dividends is called the dividend payout ratio, and the retained portion of profits is called retention ratio.